Okay, I know what you're thinking. How to lose money trading? It sounds kind of backward, right? But trust me on this. The single best way to learn how not to lose money is to first understand exactly how it happens. So this isn't some get-rich-quick scheme. Think of it more as a survival guide based on some amazing work by technical analyst Jim Stromberg for finding your way through the pretty treacherous waters of the stock market. So, does this chart look a little familiar? Yeah, it's every trader's biggest nightmare. You buy in at the absolute top, feeling like a genius, right before it all comes crashing down. For way too many people, this is where their trading story ends. But today, we're going to map out exactly how you can write a very, very different ending. You've got to understand something from the get-go. The market isn't always a friendly place. As Stromberg puts it, it's really an ecosystem, and it's filled with experienced traders, you could call them predators, who literally profit from the same predictable mistakes that newcomers make over and over again. Your best defense isn't going to be luck, it's knowledge, and that's what we're here to build today. So where does it all go wrong? Well, the first huge mistake, and it's a big one, is ignoring the crowd. It's not just about knowing when the party's getting started, it's about knowing when everyone's about to leave. That's the important part. Now, most people look at volume, the number of shares being traded, but that's only giving you half the picture. A much, much better way to look at it is liquidity. See, by multiplying the price times the volume, you're not just seeing random activity, you're seeing the actual financial energy, the fuel that's being pumped into a stock. It's a way more accurate measure of what's really going on. And this slide just shows you the difference perfectly. I mean, look at the left. You've got these raw volume bars. It's a mess, right? It's choppy, it's confusing, you can't really spot a pattern. But now look at the chart on the right. By smoothing out that liquidity, you get this beautiful, clear line that shows you the real trend of money. It literally turns all that noise into a clear signal. So here's the golden rule you need to burn into your brain. And a healthy move up, as the price is climbing, that financial energy, that liquidity, should be climbing right along with it. But the real danger sign is something called divergence. That's when the price is still inching up, but the fuel is starting to dry out. That's a huge red flag that the whole rally is just running on fumes. Which brings us to a question you have to ask yourself. If you look at a chart and you see that the financial energy, the liquidity, is at an all-time high, that means the excitement is completely maxed out. Buying at that point, it's like showing up to the party just as everyone is grabbing their coats and heading for the door. It is one of the easiest ways to get caught holding the bag. All right, on to the second classic mistake, not seeing the invisible walls. You have to think of stock prices like they're bouncing around inside a room, with invisible floors and ceilings that are created by what other traders have done in the past. And ignoring them? That's like trying to drive with your eyes closed. Now, what's so cool about this slide is how it lets you see these walls. You see those bars on the right? That's accumulated volume. It shows you how many shares have traded at every single price level. So, a big bar below the current price, that acts like a floor or support because all the people who bought there are going to try to defend it. A big bar above, that's a ceiling or resistance because a ton of people are just waiting for the price to get back there so they can sell. It's like a collective memory for the stock. And this right here leads to probably one of the most important survival rules you'll ever learn. If you're thinking about buying a stock and you look at that chart and see nothing but empty space below the current price, no floor, no support, you are making an incredibly dangerous bet. Because if that thing starts to fall, there is absolutely nothing there to stop it. And here is a perfect real-world example. This is a tweet from stockinvest.us showing a chart of Snap. Now notice how the price is way up high, but if you look at that accumulated volume on the right, there's just this huge air pocket right underneath it. The chart is basically screaming at you, there is no support. And here's what happened next. The stock just plunged. It didn't just dip a little, it fell off a cliff, collapsing from over 18 bucks all the way down to 5. This is the brutal, brutal result of what happens when there's no floor to catch a falling price. Okay. That brings us to our third and final mistake, and this one is all about momentum. We call it chasing trains. Jumping on a stock that's already flying at full speed, right before it's about to run out of track. So the tool we use to measure this is called the Relative Strength Index, or RSI for short. Don't let the name freak you out. All it is a speedometer for a stock. It just tells you how fast the price has been moving, on a super simple scale from 0 to 100. That's it. Now, the simple textbook rule that everybody learns first is this. If the RSI goes above 70, the stock is overbought and is probably going to fall. If it drops below 30, it's oversold, and it might be a great deal. Sounds easy enough, right?
Well, if trading was really that simple, we'd all be rich by now. That simple rule leaves out one absolutely critical piece of the puzzle, and ignoring it is another fantastic way to lose your shirt.
I mean, just look at this chart. The stock became oversold way back here, at the beginning of this 2-month period. If you had bought it based on that simple little rule, you would have just watched an absolute horror as the price just kept grinding lower and lower and lower. It stayed oversold the entire time it was falling apart. So here's the real key, the big takeaway. RSI is not some magic bullet. Its signals mean completely different things depending on the overall trend. In a strong downtrend, a stock can stay oversold for months, and in a really powerful uptrend, it can stay overbought for just as long. It's like looking at your car's speedometer without knowing if you're driving uphill or downhill. Without that context, the number is pretty much meaningless.
Okay, so we've covered the 3 biggest, most common mistakes that trip up traders. Now, let's pull it all together into a simple checklist you can actually use. Your very first trading rulebook to help you survive out there and make smarter decisions.
Here it is, just 3 steps to think about before you make a trade. Step 1, check the crowd. Look at that smoothed liquidity. Is the energy rising with the price or is it fading away? Step 2, mind the gaps. Check that accumulated volume. Is there a solid floor underneath you? And step 3, check the speed with RSI. But, and this is the important part, always check it in the context of the overall trend. This simple process can help you dodge so many of the most common traps.
And we'll end with this really powerful quote. The whole point of technical analysis isn't to perfectly predict the future. Nobody can do that. It's to remove your assumptions, the dangerous assumption that a rising stock has to keep rising or that some simple rule is always going to work. It's about replacing wishful thinking with actual evidence. And that is how you write a different story for yourself in the market.